Welcome back to Accounting 301 Financial Accounting. Before watching this video, you should have read Chapter 2 and watched the interactive presentation so that you will have some understanding of the concepts we will be covering. In Chapter 1, you learned about transaction analysis, some important business terminology, and were introduced to financial statements. In Chapter 2, we will start using the language of business, accounting. When you study a new language, you have to learn new words, define what they mean, and you have to figure out how to put those words in sentences that make sense. Chapter 2 teaches us to do the same thing using the language of accounting, so it is very important, foundational chapter for you. We will analyze transactions using source documents, learn how to record them in the accounting system using a journal, post journals by account to the general ledger, and summarize the cumulative effect of all transactions in the trial balance. Then we will use the trial balance to prepare financial statements. In other words, we are now actively engaged in writing a novel using the language of accounting for the users of financial information, lenders, and company owners. A good study habit is to review the chapter learning objectives before and after you study the chapter. Learning objectives are like a roadmap. They tell you where you are going and remind you where you have been. They also help you from getting lost in all the details you are learning, which sure can be easy to do. Please keep the chapter checklist handy so you can keep an eye on the big picture, that is, the learning objectives for each chapter. The accounting process identifies business transactions and events, analyzes and records their effects, and summarizes and presents information in reports and financial statements. These reports and statements are used for making investing, lending, and other business decisions. The steps in the accounting process that focus on analyzing and recording transactions and events are shown on this slide. We begin by the accounting process by analyzing source documents. For example, you usually receive a receipt when you pay cash for something. Think about the last time you went to a fast food restaurant. When you received your order, you were given a receipt. That is a source document. Once we identify a business transaction, we record it in a journal. A journal is simply a listing of all transactions of a business arranged in date order. At the end of the period, usually a month, transactions in the journal are recorded, accountants say posted, to a general ledger account. Posting is a systematic process of transferring information from the journal to the ledger. The ledger groups transactions by the accounts impacted. Every asset, liability, equity element, revenue, or expense has an account created in the ledger for it. For example, we will have a ledger account for cash. All transactions that result in increases or decreases in the cash account will be posted to the cash ledger account. Once all transactions have been posted, we prepare the trial balance. The purpose of the trial balance is to make sure that all transactions have been transferred properly into the ledger. The trial balance is a listing of all account balances in the ledger. We will discuss each of these steps in more detail as we go through the chapter. A source document is evidence a transaction really occurred. Accountants use source documents to help prove what a transaction was for and how much to write down in the accounting records. Source documents identify and describe transactions and events entering the accounting process. They are the sources of accounting information and can be either in hard copy or electronic form. Almost all businesses use sales orders, purchase orders, statements from suppliers, canceled checks, bank statements, shipping notices, packing slips, and the like to support the existence of a transaction. In today's highly computerized environment, many source documents are stored digitally. Knowing how to access these digital source documents is an important part of accounting. An account is a record of all the increases and the decreases in a specific asset, liability, equity, revenue, or expense item. Think of the account for cash. All companies have a cash account to reflect what happens to their bank account. To make it personal, whenever you get paid, your cash account increases, and whenever you spend money, your cash account decreases. The general ledger is a record containing all accounts used by the company. The accounts are arranged in the order of the balance sheet, that is, assets, liabilities, equity, revenues, and expenses, and report balances after every transaction. The general ledger is like a bucket that holds all accounts. It contains everything that happened to each account, all of the history of a company's transactions in date order for each account since the company started. The general ledger also shows a running balance for each account. Recall the basic accounting equation. Assets are equal to liabilities plus equity. When we consider the balances of all accounts in the general ledger, the accounting equation is also true. The total of all asset balances added together is equal to the total balance of all liabilities plus all equity accounts. We will see the accounting equation hold true later when we summarize the general ledger balances and the trial balance. We introduced assets in Chapter 1. They are things a company owns to either use in the business or to sell in the business. Here are some of the common asset accounts we are likely to find in all businesses. They are discussed in detail in your textbook. Now, prepaid accounts may be new to you. Think about your auto insurance. Many of us pay our auto insurance semi-annually or annually. The payment is made in advance and is referred to as a prepaid amount. As we use the insurance up every month, we transfer a prorated amount of the prepaid account to expense, for example, insurance expense. This is a perfect example of how the matching principle works. We will discuss the accounting for prepaid expenses more in Chapter 3. As you recall from Chapter 1, liabilities are amounts we owe to other people. Here are some of the common liability accounts we are likely to see in the general ledger. An unearned revenue account is a special type of liability that is the opposite of a prepaid account. Here, the company has received money but hasn't done anything to earn it yet. The company takes the money and makes a promise to provide a product or service in the future. A familiar local example for you would be season tickets for the Sacramento Kings. The team sells season tickets well in advance of playing any games. They get the money up front, but do not earn ticket revenue until a game has been played. Once a game is played, the company records a portion of the money received as revenue by transferring it out of the unearned revenue account to the revenue account. Once the season is over, all the revenues will be earned and the liability no longer exists. This is an example of how the revenue recognition principle works. We will discuss the accounting for unearned revenue in more detail in Chapter 3. Recall from Chapter 1 that equity is what is owed to owners after all liabilities have been deducted from assets. Equity is made up of common stock and retained earnings. Retained earnings is like a bucket that holds revenues, expenses, and dividends. If you want to remember how each of these account types impact equity, think about the steps you need to take to produce a statement of retained earnings. Revenues minus expenses equals net income. Net income increases retained earnings, and dividends reduce retained earnings. Well, that's it for now. See you in our next discussion about debits and credits.